Welcome to Finance Made Easy. Today marks the second week of our course. In this week, I will guide you through the historical evolution of various financial markets. We have all heard a lot of negative reports about China's financial markets. LETV as massive credit crisis, Aaron's Ponzi scheme, the pitfalls of bank wealth management. Many people might feel that China's financial markets are chaotic and full of problems. So why not just adopt a copycat approach, bringing over the financial products and regulations from the developed Western markets and applying them directly to China? Every time I hear this suggestion, I feel the urge to tell them that no financial market appears out of nowhere. There is always a powerful historical and institutional foundation behind its formation. And because these foundations differ from one another, you cannot simply copy them. For example, Europe's financial markets evolved in a context where many small nations existed, each governing their own territories. Meanwhile, China's financial markets evolved from a centralized imperial system. These two market genomes are different, and transplantation is not that simple. Today, we'll focus on the institutional roots of China's financial markets. Once we've covered that, you'll understand some of the financial phenomena I just mentioned. Early Chinese finance was very advanced, and China was in a leading position globally. For instance, during the Qin dynasty, there was a unified currency. Under the Han Dynasty, commercial credit was highly developed. By the Tang Dynasty, the monetary economy reached its peak, and a complete system of commercial bills called flying money emerged, along with the early form of banks called Kui-Fang. In the Song dynasty, China even invented the world's first paper money, Xiaozi 400 to 500 years before Europe. So why did we have such an advanced monetary financial system in ancient times? It is closely related to our centralized imperial system and the state-owned economic system of official monopolies. As we all know, Emperor Qin Shi Huang established a highly centralized empire, and under this system, the emperor was the son of heaven with supreme authority. This made it easy to create a unified national market. With a unified currency, the market also became unified without barriers. In such a unified market and currency system, the monetary financial system could develop, and this was a lasting influence of Qin Shi Huang's reforms on later generations. Another significant development was the state monopoly of salt and iron policy during the reign of Emperor Wu of Han. We know that Emperor Wu was heavily militaristic, which led to significant strain on the central finances. His advisor Sang Hongyang suggested that the state take control of profitable industries such as salt and iron, turning them into state-run monopolies. This financial strategy raised substantial funds for the emperor, strengthened central control, and curbed the power of local forces. Later emperors realized that this form of state-controlled economic regulation was the key to strengthening the central treasury. Over time, nearly all essential economic goods, such as tea and silk, were monopolized by the state, forming an important part of China's financial system for thousands of years. In general, the financial system of the Chinese Empire was a top-down monetary economy, closely tied to central government control. We can call this the centralized monetary fiscal system. In the early stages of society, when productivity and capital accumulation were low, this system proved to be highly effective in mobilizing resources. This explains why China's early monetary economy was particularly advanced. However, as with any system, there were both advantages and disadvantages. By the Ming and Qing dynasties, the drawbacks of this system started to show. The biggest flaw was that only one entity had authority and absolute credit, the emperor. This meant that in history, we only saw state and imperial credit, not private sector credit, which hindered the development of a credit culture among the people. A fascinating example is the Shaanxi Paiyao Hao. By the Ming and Qing dynasties, Shaanxi as financial institutions had grown so large that even Empress Dowager Cixi needed to borrow money from them. But as time went on and foreign institutions entered the scene, these private financial institutions quickly declined. Why? The key issue was that while the Shaanxi Piaohou were private institutions, they lacked the ability to raise funds at the scale that state-owned entities could. Moreover, the common people didn't trust them. If a new local official seized their assets, or if a dynastic change occurred, all their wealth could be lost. So, overall, the Shaanxi Piaohou had weaker fundraising capabilities, which stemmed from the weakness of private sector credit in China. Thus, this double-edged sword, the centralized monetary fiscal system, is the institutional root of China's financial markets. History is a continuum. Today's financial markets might look very different from ancient China's monetary system, but the roots are still very much alike. In essence, they're a version of the centralized monetary fiscal system, with the state continually seeking to control financial resources in order to concentrate power to achieve great things. Almost all the financial systems we see in the market today are top-down designs that align with the central government's goals. A typical example is the establishment of the A-share market, which was designed to rescue state-owned enterprises. In the 1990s, China's economy faced serious difficulties, with many state-owned enterprises on the brink of bankruptcy and state-owned banks close to collapse. The state needed to find new financing channels to support these companies. The A-share market was created in this context, and to support state-owned enterprises, early regulations were set up with discriminatory clauses, such as quotas to allocate listing rights to state-owned enterprises from different regions and ministries. There were also non-transferable legal person shares, meaning the public had to pay higher prices for circulating shares, allowing state-owned enterprises to raise capital. All of this was designed to rescue state-owned enterprises. Although the A-share market has undergone many reforms since then, remnants of planned policies and discriminatory clauses still exist today. The market still harbors significant opportunities for rent-seeking behaviors, which often result in corruption and insider trading. This is closely related to the historical institutional roots of our centralized monetary fiscal system. There are many other examples of this phenomenon. For instance, why are interest rates in our banks so low? It's because the state wants to concentrate power to achieve great things, which means it needs to collect the public as savings at low rates and channel the cheap funds into state-prioritized industries. As a result, banks lower interest rates on personal deposits while making it hard for small and medium-sized private businesses to get loans. Or even if they do, the loan interest rates are excessively high. This creates a large interest rate gap where funds are extracted to support sectors the state wishes to prioritize. This method of centralizing financial resources is not entirely without benefits. For example, after the state gained control over financial resources, it invested heavily in infrastructure, such as energy and power. In developing countries, China has a particularly complete industrial system, and this foundation was laid starting in the 1950s. The development of heavy industry in the 1950s and urban infrastructure in the 1990s were heavily supported by the state's control of financial resources and its focus on infrastructure projects. However, the consequences are also reminiscent of the past. By controlling all funds and resources, the state monopolizes financial power, leaving private sector credit weak and the overall society lacking in a credit culture. After the state monopolized financial resources, people's need for wealth management was heavily suppressed, pushing them to engage in gray market activities. For example, in the 1990s, there were many illegal fundraising cases. More recently, internet finance and P2P lending exploded, which had similar outcomes. Why are there so many asset bubbles in the market, with people speculating on anything from stones to cigarettes and stamps? These may seem like isolated events, but the underlying cause is the same: the legacy of the centralized monetary fiscal system from the Qin and Han Dynasties. So we can say that whether it is the developed monetary economy of ancient China or the underdeveloped financial market of today, the evolution of financial markets is much like a person's genetic makeup, with both strengths and weaknesses embedded in it. The institutional roots of our centralized monetary fiscal system have created many opportunities for us, but they've also caused a lot of problems. The financial reforms we are undertaking now are much like gene modification. It is not something that can be accomplished overnight. That is why I initially said that the simplistic copycat approach simply won to work. This is finance made easy, helping you gain a higher perspective and re-understand wealth.